Welcome back. Today we're diving into a topic that impacts everyone. Taxes. Taxes might not be thrilling, but getting more of your own money back? That's exciting. A bigger refund isn't luck, it's the result of smart planning and knowing your options. Many people miss out simply because they don't know what they're entitled to. I'm breaking down 7 actionable tips to help you maximize your tax refund for 2025. These are practical moves anyone can use to keep more of their money. Let's jump right into the first tip. First up, let's dive into a crucial aspect of managing your finances. Adjust your tax withholding. This is a fundamental step in ensuring you're not giving the government more money than necessary throughout the year. Every paycheck, without fail, your employer withholds money for taxes. This amount is based on the information you provided on your W-4 form. It's a critical piece of the financial puzzle. Most people fill out their W-4 once, typically, and then promptly never update it, often forgetting about it entirely. But life is dynamic, and as life changes, consider events like marriage, the arrival of kids, or starting new jobs. These milestones significantly impact your tax situation. If your W-4 is outdated, reflecting an old life situation, you might be overpaying your taxes significantly, essentially giving the government an interest-free loan throughout the year. You're letting them hold on to your money without any benefit to you. Instead, aim to keep more of your hard-earned money throughout the year, where it belongs, by proactively updating your W-4 form whenever your life situation changes. This puts you in control. A fantastic resource is the IRS Tax Withholding Estimator, available online. To use it effectively, gather your latest pay stubs and a copy of last year's tax return. The tool then tells you exactly with precision how to accurately fill out a new W-4 form step by step. Once completed, submit the updated form promptly directly to your HR department. They'll process the changes and adjust your withholding accordingly. Make it a habit to review your withholding every year without exception, and certainly after any major life events occur. Don't let these slip by unnoticed. Even a seemingly small adjustment to your W-4 can translate to more money in your pocket each and every month. Don't just set it and forget it. That's a common mistake with significant consequences. Be proactive in managing your tax withholding. This proactive approach is the very foundation for optimizing your cash flow, making smarter financial decisions, and ultimately, building wealth. So, take just 15 minutes to check your W-4. It's a small investment of time because you might be overpaying by hundreds or even thousands of dollars each year. Get this right, take control, and you're firmly in control of your finances, empowered to make the best choices for your future. Now that we've covered withholding, let's move to the next tip to further enhance your financial strategy. Tip 2. Maximize your retirement contributions. This is a cornerstone of smart financial planning, and it's something you should prioritize year after year. Think of it as investing in your future self, ensuring a comfortable and secure retirement. Contributing to a traditional 401k is a powerful way to save for retirement. It's often offered through your employer, making it convenient to set up and contribute regularly. Or IRA. An IRA or individual retirement account is another excellent option, especially if your employer doesn't offer a 401k or if you want to supplement your existing retirement savings. Contributing to these accounts reduces your taxable income now and builds your future. This means you pay less in taxes today while simultaneously growing your nest egg for tomorrow. It's a win-win situation. For example, if you earn $70,000 and contribute $5,000 to your 401k, that's money that isn't subject to income tax this year. You're only taxed on $65,000. This reduction in taxable income can have a significant impact on your overall tax liability. That could save you over $1,000 in taxes depending on your individual circumstances and tax bracket. Depending on your bracket. The higher your tax bracket, the more you'll save by reducing your taxable income. If your employer offers a match, this is essentially free money that they're offering as part of your benefits package. Contribute at least enough to get the full match. Failing to do so is like leaving money on the table. It's free money. Don't miss out on this valuable opportunity to boost your retirement savings. No 401k? Don't worry, you still have options. Open a traditional IRA. This is a great alternative for those who don't have access to a 401k through their employer, and contribute up to $7,000. This is the current contribution limit for those under 50, $8,000 if you're 50 plus. This catch-up contribution allows older workers to save even more for retirement. You can make IRA contributions up to the tax filing deadline, which is typically in April, for the previous year. This gives you some extra time to contribute and potentially lower your tax bill. If you owe more than expected, a last-minute IRA contribution can lower your bill. It's a smart way to reduce your tax burden and save for retirement simultaneously, or boost your refund. Who doesn't love getting a little extra money back from the government? Increase your contribution percentage if you can. Even a small increase can make a big difference over time. Even 1% more makes a difference. Think of it as a small sacrifice today for a much larger reward in the future. This strategy defers taxes until retirement, when you may be in a lower bracket. This can result in significant tax savings over the long term. It's the most effective way to build wealth and cut your tax bill at the same time. It's a powerful combination that can help you achieve your financial goals. Don't leave this benefit on the table. Take advantage of the tax advantages offered by retirement accounts. Pay yourself first by prioritizing your retirement savings, and let the tax savings grow. Over time, the power of compounding can significantly increase your retirement savings. Next, let's talk about tax credits. These are another valuable tool for reducing your tax liability. On to tip 3. Tip 3. Let's dive into the world of tax credits. These are often overlooked, but they can be a game changer when it comes to reducing your tax burden. Claim every tax credit you qualify for. It's like finding free money that the government offers to help ease financial burdens and encourage certain behaviors. Credits are better than deductions. Think of them as a direct discount on your tax bill. They reduce your tax bill dollar for dollar. A $1,000 credit, for example, reduces your taxes owed by exactly $1,000. This is a much more powerful benefit than a deduction, which only reduces the amount of your income that is subject to tax. The Earned Income Tax Credit, EITC, is refundable, and it's designed to help low to moderate income workers and families, meaning you can get money back even if you owe nothing. Even if your tax liability is zero, the EITC can result in a refund check from the IRS. The child tax credit is another big one for families, providing significant relief for the expenses of raising children, and part of it can be refundable, meaning you could receive some of the credit back as a refund, even if you don't owe any taxes. Education credits like the American Opportunity Tax Credit, which is for the first 4 years of higher education, and Lifetime Learning Credit, which covers courses taken to improve job skills, can save you thousands if you're paying for school. These credits help offset the costs of tuition, fees, and course materials. Don't forget the Child and Dependent Care Credit, a valuable resource for working families with young children. If you pay for childcare so you can work, this credit can help offset those expenses, making it more affordable to balance work and family responsibilities. There are also credits for energy-efficient home improvements, encouraging homeowners to invest in upgrades that reduce energy consumption and lower utility bills, and electric vehicles. These incentives are designed to promote environmentally friendly choices and reduce our carbon footprint. Tax software or a professional can be invaluable resources in navigating the complex world of tax credits. Can help you find every credit you're eligible for, ensuring you don't leave any money on the table. Don't assume you don't qualify. Many credits have income limits and other requirements, but it's always worth checking to see if you're eligible. Millions miss out every year, simply because they don't realize they're eligible or they find the process too confusing. Read instructions, answer all questions, and be thorough in your tax preparation. And check the IRS website for updates. Tax laws and regulations can change frequently, so it's important to stay informed. A few minutes of research can make a significant difference in your tax outcome. Could mean hundreds or thousands back in your pocket. That extra money can be used for savings, investments, or to cover essential expenses. Be your own advocate and take control of your tax situation. And claim what's yours. You're entitled to every tax benefit you qualify for, so don't hesitate to pursue them. Credits are the fastest way to boost your refund and put more money back where it belongs, in your pocket. Now, let's look at charitable donations and how they can impact your taxes. Tip 4, coming up. Tip 4. Deduct your charitable donations. To claim this, you usually need to itemize deductions, so your total itemized deductions must exceed the standard deduction. Cash donations count, but you need records. Bank statements or receipts for anything under $250, and a written acknowledgement for larger gifts. Non-cash donations like clothes or furniture are deductible at fair market value. Take photos, make a list, and get a receipt. Use valuation guides to estimate what your donated items are worth. track every donation in a folder, physical or digital. Out-of-pocket expenses for volunteering like uniforms or mileage can also be deductible. Consider bunching donations. Combine 2 years' worth into one to exceed the standard deduction and maximize your benefit. Keep all documentation organized for tax time. Don't miss out on deductions for your generosity. A little discipline goes a long way. Next, let's talk about medical and work-related expenses. Tip 5 is up next. Stay organized and you'll see the rewards. Let's keep going. Tip 5, track medical and certain work-related expenses. Medical expenses are deductible if they exceed 7.5% of your adjusted gross income. Qualifying expenses include doctor visits, dental care, prescriptions, eyeglasses, and some insurance premiums. Home modifications for medical reasons and travel for care can also count. Keep every receipt and bill, don't guess. Most people don't qualify, but a big medical event could push you over the threshold. For unreimbursed employee expenses, most W-2 employees can't deduct these federally, but some special categories, like reservists or performing artists, can. Check your state's rules. Some allow these deductions even if the IRS doesn't. Track everything in a spreadsheet or app as it happens. Don't wait until tax time to organize. Even if you don't qualify this year, you'll be ready if things change. Being organized is half the battle. Now let's talk about education deductions. Tip 6 is next. Stay sharp, these add up. Tip 6. Use education deductions, especially the student loan interest deduction. You can deduct up to $2,500 in student loan interest, even if you take the standard deduction. This lowers your AGI, which can help you qualify for other credits. The deduction applies to federal and private loans for you, your spouse, or a dependent. If you paid $600 plus in interest, your lender sends you Form 1098E. If less, check your statements. Income limits apply, so check the current year's thresholds. The tuition and fees deduction has expired, so focus on student loan interest and education credits. Make sure you enter the correct numbers when filing. Even a small deduction can save you hundreds. Don't leave money on the table if you're paying student loans. Last tip coming up. Tip 7. File your taxes electronically and as early as possible. E-filing is faster, more accurate, and reduces errors that can delay your refund. Tax software guides you step by step and helps you find every deduction and credit. Combine e-filing with direct deposit for the fastest refund, usually under 21 days. Filing early protects you from tax identity theft. If you file first, scammers can't claim your refund. You'll also get your money sooner, so you can put it to work right away. If you owe, filing early gives you time to plan and save before the payment deadline. Gather your documents as soon as they arrive in January. Use reputable software like TurboTax, H&R Block, or Free Tax USA. Don't wait until April. Be proactive and stress-free. Filing early gives you peace of mind and control. Technology makes it easy. Embrace it. Get your refund quickly and securely. That's the final tip. Let's wrap up. Here's what to do next. That's it. 7 powerful ways to boost your tax refund in 2025. Remember, your refund is just your own money coming back. Plan ahead to keep more of it. I'm not a tax professional, so consult a CPA or enrolled agent for advice tailored to you. If you found this helpful, hit like and subscribe for more money tips. Share your own tax-saving tips in the comments below. Thanks for watching, and here's to a smarter, wealthier year ahead. See you in the next video.